Most people see a bank as a secure fortress, a passive vault where personal wealth is stored and protected. But look at the trajectory of the modern worker. Even as salaries increase over a lifetime, actual savings for the average household remain mathematically flat. This stagnation is the product of a specific, carefully constructed financial architecture. Everyday financial products are governed by hidden mathematical formulas. These formulas are designed to extract wealth from the middle class and transfer it directly to the financial sector. The first mechanism of extraction is simple. A bank uses your deposited money as inventory to lend to others. This chart shows the math. You deposit $10,000 into a savings account, receiving a return of roughly 1%. Simultaneously, the bank lends that exact $10,000 to another consumer, charging rates from 12 to 26%. This systemic mechanism is known as fractional reserve banking. The entire banking business model relies on the depositor remaining unaware of the massive mathematical spread being earned on their own capital. The second mechanism is the division of total costs. By slicing a large expense into a small monthly payment, the system obscures how much a consumer is actually spending. Here's a basic consumer purchase. A $5,000 loan at 18% translates to a harmless $250 a month. Over 2 years, payments total $6,000. $1,000 is vaporized just to avoid paying up front. This effect is even more extreme with credit cards. By paying only the minimum amount due against a 29% APR, the debt becomes nearly permanent. Mathematically, paying only the minimum on a $5,000 balance can drag on for 8 years. By the time the debt is cleared, it has cost the consumer over $15,000. The minimum payment option serves a clear purpose. It maximizes the lifespan and profitability of your consumption debt. The third mechanism ensures the bank extracts its profit before the consumer makes any real progress on the debt. This is achieved through amortization. On a standard 30-year mortgage, the repayment schedule is heavily front-loaded toward interest rather than the principal loan balance. On a $400,000 loan, your first payment is $2,600. Over $2,300 is pure interest. Only $300 reduces the debt. After 5 years of payments totaling $160,000, the balance drops by just $20,000. This interest is supplemented by fee income departments. They generate billions from origination fees, late penalties, and administrative charges. There is also the quiet drain of auto-renewal monetization, where maintenance charges slowly erode dormant savings accounts and forgotten subscriptions. Between front-loaded amortization and automated fees, the financial architecture guarantees bank profits, regardless of the consumer's actual financial health. Stagnant salaries combined with constant installment payments create golden handcuffs, keeping the middle class dependent on the next paycheck to cover current debt. Financially elite individuals avoid this by refusing to take loans for depreciating assets like electronics or vacations. They also invert the credit card model. By paying the full balance before the due date, they turn a high-interest product into a free 45-day loan funded by the bank. Escaping the trap requires automating investments so that money moves into wealth-building accounts before any lifestyle spending occurs. Before signing any financial agreement, demand the total cost of credit. Do not focus on the monthly installment. Look at the total amount you will pay from start to finish. The financial system is designed to profit from a lack of clarity. Structural discipline and a focus on total costs are the tools you need to reclaim your wealth.